Ed Egilinksy, the managing director, head of alternative investments at Direxion. Ed, welcome. Gold back to near, good morning, back to near 2K. Has the bulls cheering ole?
That's a good one for a Friday. Gold, started to catch a bid last month, mostly due to the Middle East conflict, so that flight to safety. But it's interesting. In November, it's lagged somewhat, despite the fact that rates have declined and the dollar has weakened a bit until yesterday, with the jobless claims numbers, being the highest in about 2 years. So I think 2K is a psychological number now for gold to break through. As long as you have some catalyst there, particularly the weaker dollar, if that continues and the narrative low of interest rates starting to move down, I think you'll see gold push through that. Also, keep in mind, Ben, the Bitcoin craze is back. So especially for the quarter. And that might take some of the luster, no pun intended, away from gold. And look what Einhorn is, you saw his 13F, fear of a recession. So players like that are starting to build positions in gold.
Ed, talk to me. Actually, before we do, I want to just pull this chart here real quick and show you that, well, relative to my point a minute ago about a win for the bulls, right? Holding above the 50, above the 200-day moving average. I mean, here you can see that longer-term chart really speaks to the bullish narrative associated with gold at these current levels, just shy of 2,100. What is the recent inflation data that we saw, the latest numbers, the figures suggest about the broader commodity markets in general?
Well, I think if you look at it, it's a tailwind in terms of the weaker dollar for most commodities. As long as you get, and I'll put that in quotes like everybody else, that soft landing scenario that people keep talking about, that remains to be seen. So I think that'll help the broader commodity markets in general, but certainly the precious metals. If rates start subsiding and you get the dollar to weaken coinciding with that, they could be the biggest beneficiaries. But I wouldn't at this point just call it a victory that the Fed's done raising rates. Certainly, the last Fed meeting and some of the recent economic data suggests that, and the Fed fund futures are reflecting that. In fact, a couple of cuts next year. But it'll only take one or two HODL prints again to get that narrative to change. So I don't think it's the all clear yet in terms of rates not being higher for longer.
Ed, gold on the move. Oftentimes people look for silver to participate as well. Do you think you can extend that recent run-up we've seen into the end of the year here as we watch gold continue to hold these upper levels? Will silver?
Well, it's interesting. Silver's basically treading water this year. It's had a recent bullish move. Year to date, it's been relatively flat. I would look at short-term supported around 2280 with silver, Ben. Silver has that twofold usage. One is that flight to safety. The other is industrial production. So you need that industrial demand component to keep improving. And in regards to alternative energy, they are used with solar panels. So if you get that alternative energy initiative momentum starting again, that could be a further impetus for silver. And when you look at the gold-silver ratio, I know you love this one, Ben, it's in the mid-80s right now, roughly. Silver is cheap relative to gold if you look at the ratio from a historic standpoint. So I think silver's still a play to the upside as long as the short-term bullish scenario holds at 2280 level.
I would have to agree, and I'm looking at silver taking out that 50-day moving average here. It's got some energy as well, along with that move up we're seeing in gold. Let me shift gears a little bit, but kind of stick with that industrial narrative. Talk to me about copper, what's playing out there. It looks like structurally in a very similar situation, just above that 50-day moving average as well, but benefiting from that weaker dollar.
Yeah, definitely. But, that China data, Ben, was mixed this week. And my biggest concern with copper is the property narrative continues to be very weak in China. You talked about some U.S. data, housing data, and some that's coming out. So maybe rates dropping could help the narrative here with housing. But when you look at China, stimulus, I think, is going to be a key to prop copper much higher than here. Copper's got to hold support around 350, Ben. And I think from an upside longer-term bull scenario, that eclipsing of $4 again is going to be key. And again, with copper, the green initiatives with electric vehicles and within wind turbines could be some help to prices as well. But, China, when copper is a bellwether for China and the global economy, although it's shown some signs of life here, copper, I think it's more due to the weaker dollar than any of the fundamentals, Ben.
Ed, how's the Direxion Com ETF positioned headed into the end of the year? We've seen some declines here from 3162 beginning of May, it looks like, down to recently that 2850 level. Taking a look at the chart here, I want to point to how this area seems like a significant area as I look. You can see the trend to the downside again since the beginning of May, but as I broaden out our scope here a little bit, you can see how we're retesting a key area that we saw back in the end of 2021, beginning of 2022. Ed, what are we looking for here in the next couple months?
Well, COM, the one wild card, Ben, it's not a static, passive, long-only commodity benchmark like the Goldman Sachs Commodity Index or the BCOM. They're good proxies for the space. But this is different in terms of being a long, flat commodity strategy. That'll be long a commodity showing a favorable price trend, but in cash with commodity showing downward price trend. And right now, we're long 5 out of the 12 commodities within the portfolio. We just went to cash with cotton and natural gas, and that was due to the downward price trend action. So this is a little different in terms of when you look at a chart of this relative to maybe a static, passive, long-only broad commodity benchmark, because it is not static. And we can be long anywhere from 0 to 12 commodities and anywhere in between. So if the narrative gets worse, I would expect us to go more to cash with those individual commodities we're long right now. And we're long right now most of the energy components as well as sugar and soybeans.
Well, I'd imagine in terms of determining how much cash you should be involved in relative to some of the other products here, you're going to continue to watch the China narrative, as we will also. Ed, appreciate you joining us here. A solid look at metals here.
Have a good weekend.
You too, Ed. Gold, copper, silver, across the board here. Ed Egilinksy joining us from Direxion.